Hi, thanks so much for tuning in. You're watching BQ Prime, and I am at the CMT Association event here in Mumbai. We've been talking markets, we've been talking technicals. I am in conversation right now with Tyler Wood, who is the managing director of the CMT Association, and in fact also the co-founder of Go No Go Charts. Thanks so much, Tyler, for taking the time. You're familiar with India. You've been here several times over the course of the last two decades.
Yeah, first trip was in 2001, and I think this is my 26th or 27th visit to India.
Okay, so you probably, in fact, you pointed out that you were here before JJ Flyover in Mumbai was built.
Absolutely.
But I want to get straight into the conversation. I want to ask you about the technicals. I want to ask you about markets, international markets. Sure. We were talking just before we started the conversation about the mood, the trends.
Yep.
What stands out right now with regard to the US markets, and then we'll broaden the scope?
Sure. I think everything is being driven by interest rates, which are a reflection of our ability to or failure to combat inflation. So in the US in September, the annualized number is about 8.2% inflation. And we've had several rate hikes by the central bank to try to combat that, to get that under control. We're at about 4%. But when you look at like a 40-year chart of the TNX, so that's the 10-year treasury yield, you see that this downtrend began when I was born. I probably top-ticked the bond market. And for 40 years, we've had this very steady, durable decline in bond prices, in yields, excuse me. And we've broken out of that 40-year trend line. So as a chartered market technician, when I see something on a very long-term basis, right, we're looking at quarterly data, a quarterly candle. When that breaks a 40-year, multi-decade trend line, it means we're in a regime shift. The nature of the markets are changing. So in that rising rate environment, the things that were working before don't tend to continue to work. So we've had a lot of investors that just entered the market. As we've heard in India, went from about 50 million to 110 million market participants.
Very quickly, yeah.
Very quickly. Same thing happened in the US. Not at that scale. Everything in the US is a little smaller. But we had a huge retail participation. And so if they entered the markets in late 2020 and traded through 2021, they were bloody geniuses, right? Everything they bought went straight up.
Right.
But what were they buying? They were buying the big names that everybody talks about, the FANG stocks.
Yes.
Mega cap technology companies that were going to change the world. And in the stay-at-home trade, that worked very well.
But that's shifting now.
That is shifting now. So the nature of what works in a rising rate environment has to do with the fundamentals. And I'm sorry to use the F word for all of my fellow technicians here at the conference, but when you have a rising rate environment, the long duration equities, these growth stories, become much less attractive to institutional investors. The cost of capital is going up. So what do they want to invest? They want to invest in cash-rich companies, things with good CapEx, financials, industrials, materials companies. And we've also seen this multi-decade change in the commodities market.
And that's evident right now, Tyler. But to your point, and the F word, right?
Yeah.
But how important is it for technical chartists and traders that depend on technical strategy to be aware of fundamentals and the other way around?
It's critical. We as a CMT Association believe that technical analysis helps navigate the gap between intrinsic value and market price. So they're correlated, but they're not the same thing. You can understand the company, then you also have to understand the stock, right? When I finished my MBA program at the Kelley School of Business, I really understood corporate finance, I understood managerial accounting, and most of the entrants into the markets come from that fundamental upbringing. No long-term trend exists without strong fundamentals under the surface. Now, that gap that exists is driven by investor behavior. So we know that the market doesn't react particularly rational to all information. And these behavioral scientists, cognitive psychologists have started to give names to things that we've known about as technical analysts for years. So they talk about the herding principle, the psychology of staying together in a group. Charles Dow talked about price trends. Right. It's the same thing. They talk about anchoring bias. Yeah. We say support and resistance levels.
Recency bias.
It's just a different name to define the same activity in the market.
I do want to ask about, we were speaking about this just before we started on camera, which is that there is a deviation between the fundamental behavior and the technical or the stock price movement of certain companies.
There can be, yes.
And that has been the case in the recent past. Why do you think that is, and what have you seen?
So let's go back to the mania of 2020, right? If you look at the tulip mania, or you look at silver during the Hunt brothers, or you look at all of these bubbles that have happened through history, diapers.com in 1999, America's tech bubble. What we saw in 2020 with things like AMC movie theaters or GameStop going up 2,500%. What drives that? Well, AMC, the movie theater company, is a $6 stock. Why is it trading at $250?
Right.
Because the will of investors, the desire to catch that next move, the fear of missing out, if you will. Same thing happens in cryptocurrency markets. They're driven by investors' fear and greed, and we can see the market sustain much higher levels or much lower levels than we can deal with as investors. Market can stay irrational longer than you can stay solvent, is what we say.
Very fair point.
Yeah.
I want to ask you though, I'm sure there are a lot of budding technical analysts, chartists that are tuning into this conversation.
Yeah.
People that are traders on the shorter end of the time
Sure.
frame. The question is, because of the experience that you have, when you not get into a trade, when you stay on the sidelines, how hard, according to you, is that decision?
Emotionally or in practice? I'll give you an example. Here in 2022, we've seen a very orderly downtrend in the US market. So if you are looking at weekly charts, we're trending lower. It's clearly in a bear market. However, the relief rallies have been very volatile and very seductive. And I'm just like every other human being. I'm rooting for the stock market.
Yeah.
So when you see those relief rallies come into play, you see high volatility moves to the upside. It's very tempting to think, this is my chance, and I don't want to miss that next huge leg higher. And that's really the emotion that's driving. Right. So you have to stick to your rules and your discipline.
Okay.
We are still in a downtrend if it's a series of lower highs and lower lows. So I don't enter until that trend has changed based on my trend following rules. I think that's the discipline that the CMT program has taught me. As a chartered market technician, of course I'm going to experience the emotion, but I have this toolkit that grounds me to a set of rules and a disciplined approach.
Over the course of your career, and this is perhaps one of my last questions, have you changed your approach or strategy, or have you stuck with the same set of rules and set of strategies that you follow from the start?
Great question. I used to trade baseball cards as a kid. And let me just say, gambling is addictive to every human being, right? We're all born with that. I didn't understand how markets worked until I graduated, got my MBA, moved to New York City, and I met the wonderful Ralph Acampora and Phil Roth and Louise Yamada and Alan Shaw. And they took me aside and really coached me, really mentored me, because I was quite mistaken or unaware that these tools even existed. So the process that I'm talking about is fairly recent in my career. I've learned how to do these things just in the last decade, but I don't suspect that the process will change much. The rules are very simple. And if you stick to these basic first principles, the foundation of understanding investor psychology, you can stay out of those major losses, that risk of ruin from the big loss. So I don't expect that my rules are going to change that much. I think try to react responsibly to market moves.
Yeah, and I've heard a lot of veteran traders and investors say exactly that.
Yeah.
You limit the small losses, and you're usually better off. But thank you so much, Tyler, for taking the
Absolutely.
time. Pleasure speaking with you.
Pleasure speaking with you.